Hi, this is Phil Greenwood again from the University of Wisconsin-Madison School of Business. This next podcast, we want to talk about something that's a pretty simple concept, but yet it's probably one of the most important, especially to startups and growth-oriented craft beer producers and distributors. And it's the discussion of how free cash flow is calculated using the financial statements, and also how we can determine if we're spending more cash than we're taking in, what that burn rate is, and how long our cash will last. So free cash flow is a pretty simple concept. It literally is a formula where it equals earnings before interest and taxes, but to take that number, you have to adjust it and subtract taxes from it. So one of the ways you can do it is you calculate what a tax rate is, which would be your tax expense divided by your income before taxes. You have a percentage, you take 1 minus that tax rate and multiply that by the EBIT number, your operating profits for the particular year or quarter, and you get an after-tax EBIT number, an earnings number before after taxes but before interest. Add back any depreciation expense, subtract any change in working capital, again the current assets, current liabilities, and then subtract out any net capital expenditures, which again are fixed assets, acquisitions, things like that. What we come up with free cash flow is the cash that the organization is generating or is using up before any financing, meaning taking out any new loans, paying back any principal on loans, or selling stock and such. If we use a previous example of the craft beer distributor, this is there for 2012, 13, and 14. Here's their statement of cash flows and a calculation of free cash flow. With this company, we estimated roughly a tax rate of 40%. So for each dollar of income before taxes, they had to pay 40% in taxes to federal and state income tax authorities. So in each case, you can see the EBIT increased year to year. The tax rate stayed the same. Depreciation didn't change dramatically, but you can see by the third year in the far right column, working capital increased by $14,000 net working capital. So cash was being absorbed, plus they spent some money on capital expenditures. So if we look at free cash flow, it was at 11.3 thousand in the first year, 12 the next year, dramatically declined the following year. Now, and in fact, declining in that following year so that it actually was a negative 1.6 thousand. Now, if we wanted to kind of get an estimate of how long, based on the cash we have on hand in the bank, and how long that cash will last, we can calculate something called the cash build or burn rate. In the case of, if it's a negative free cash flow number, we divide it by the number of days in the year or the quarter. In this case, it'll be year. We'll use 365 days as the number of days in a year. Some people might use 360, some might use 270. I think it's just key that you select one and decide upon it. You take that annual free cash flow, which in the year of 2014 was negative 1,600, and divide it by 365 days, and you'll end up with what we call a burn rate. In other words, a daily burn rate. How much cash is the company spending in excess of what it's taking in? Once we have that, then we can develop a number called our time to cliff. In other words, we take the cash that we have on hand in the bank, divide it by that daily burn rate, and that will tell us how long that cash in the bank will last before we have to seek other ways of raising cash flow. Critical, though, when we use this measure is, and this is where some companies get into trouble, is they'll use a historical burn rate from what happened last year. What was the burn rate? And not take into account that they may be spending even more money in the upcoming year. So you want to make sure that you have adjusted your historical burn rate to take into account any future changes and assumptions. Now, if we are seeing a burn rate and we look like we're running out of cash, what does that mean? What can we do? Well, first place you want to start is look at your free cash flow number and try to look at ways you can impact these various variables that might help you raise cash. So you can look at the first variable, EBIT, times 1 minus the tax rate. I mean, really try to improve your operating profits or figure out a way you can lower your tax rate. Other things you can do is you could try to increase your depreciation expense, but that's hard to do since that's pretty well a fixed number. But the third item there, change in working capital. You might want to look at things. How might we lower receivables, inventory? How might we maybe not pay our bills as fast? We let our accounts payable increase. Ways that we can increase cash flow by changing working capital requirements. And then finally, maybe we can look at ways that maybe we can put off making a capital expenditure or lease something instead of paying cash for it. All of these things can be helpful in thinking of creative ways to generate cash flow if that becomes an issue in your company.